Okay. Good morning, everyone. Thank you so much for joining us for part 4 of our series of webinars. Today, we will be focusing on aspects of the Family First Coronavirus Response Act and the CARES Act that affect businesses as well as individuals. For today's session, Summit is proud to partner with BKD, CPAs, and advisors. We do have the Q&A feature available, so you can submit questions through that option. But please note that we do have hundreds of attendees joining us today, and with the meeting being so brief in time, we want to ensure we answer all questions. So please feel free to email them to us. The email address is marketing@yoursummit.com. We will respond back to you. I will display that email address again near the end of our session. So let's get started this morning. We have 3 guests joining us today. Our first is Angie Tye. Angie is a CPA and has more than 23 years of public accounting experience. Angie is a member of the American Institute of CPAs and Oklahoma Society of CPAs. Angie was honored as one of the 50 Making a Difference as part of the Journal Records Women of the Year Awards programs and as a 2015 Woman of Distinction by Tulsa Business and Legal News. Our next panelist is Todd Rolland. Todd serves as president of Summit Employees Benefit Practice. Having been with the company since its founding, he has tackled the most unique and complex employee benefit situations. Todd's professional designations include Certified Employee Benefits Specialist, Registered Employee Benefits Consultant, Retirement Plans Associate, and Group Benefits Associate. And our last panelist is Kaci Skidgel. She is the president of Retirement Plans for Summit. Kaci is the author of the book, Path to the Summit, Strategies to Reach Your Company's Peak Retirement, and was acknowledged as one of the top women advisors by the National Association of Plan Advisors for 5 consecutive years, and more recently named by Financial Times as one of the top financial advisors. With that said, I'm going to hand the session off to Kaci now, who will be moderating for today.
Well, thank you, Megan, and thank you everyone for joining us today. Appreciate your time very much. And really, before we jump into the tax implications, I wanted to pass it over to Todd just to share a couple of thoughts of what is going on from his perspective overall, the questions that you're continuing to get, and then kind of give us your update, and then we'll jump in with the tax implications with Angie. So
yeah,
Todd?
sure thing. Yeah, thank you, Kaci. Thank you, everyone, for attending this morning. A couple of things that have been coming up. Well, I guess I should suggest quite a few things out there, but the most common, first of all, I'd like to talk about material modification real briefly. For those of you out there who may have self-funded plans, partial self-funded plans, you may have administrators that could vary from a Blue Cross Blue Shield ASO administrator, United Healthcare, the Aetna, or a variety of other TPAs out there who are administering your plans. And so the idea that COVID-19, and you have the 2 different perspectives. One is you have testing with no cost share. The other was an option provided to most self-funded employers as it relates to the treatment. So you have testing, and if you're unfortunate enough to test positive, then you have treatment. So, does our plan need a material modification? Well, as an example, I would say that generally speaking, yes, your plan document does need to include a material modification, but I would encourage you all to get with your administrators, because Blue Cross Blue Shield, as an example, who administers a lot of large self-funded plans, they have determined that they don't need a material modification within their document. Now, that's their opinion, and they handle that aspect for many of you as employers out there. So I wanted to clarify that. But other third-party administrators, I'm not an attorney, but we're suggesting that, yes, material modifications need to occur. The other thing I would like to mention is, for those of you out there who may have businesses that are fully insured, most of the landscape, the insurance providers out there, and I'll mention Blue Cross just because of their prevalence, their plans have been amended in a way, the fully insured plans, that they provide coverage for both the testing and the care needed, the treatment afterward, at no cost share for participants. So that's important. That's an important distinction between fully insured and self-insured. A lot of the self-insured plans amended their plans in a way that that include no cost share for participants, but for treatment, there could still be deductible and co-insurance. So I wanted to mention that. That's become an issue that we've received a lot of questions around. The other thing I wanted to mention is to please be aware of portability and conversion provisions that may include within a voluntary group life program or even employer sponsored that is all employer paid as it relates to terminations and layoffs. This is going to become more of a focal point in our opinion with some that have unfortunately had to experience an extension from a furlough into a layoff or perhaps layoffs from the beginning. Just be aware of those trigger points and what needs to occur in terms of an employer's responsibility to a participating plan beneficiary that may be experiencing a layoff, because you want to be able to extend the portability and conversion opportunity to them. And some of that lies on the participants. The participants are required to take action. Some of it is employer required. So be sure and pay attention to that. Ask your consultants about that and clarify. I also wanted to mention that in our town hall meetings, this is what, our fourth now, we want to encourage you to forward us emails as it relates to areas that you might be interested in, not related to our agenda or our topic. We want to be a resource for those of you who need a resource. And we do have the ability to perform some research and some due diligence. So although it may not, Angie's going to be talking about tax implications, tax related issues, which would be great today. But be sure and forward us questions concerning, hey, Todd, hey, Kaci, these are things I'm thinking about. Can you help me with some insight there? If we don't include that in a town hall meeting, we at least have the opportunity to do some research and provide you some input. Likewise, we're going to continue to have town hall meetings in the future, and you all may have some topical areas we're not thinking about that would be extraordinary for the audience. So I would encourage you to email us. But those are my thoughts, Kaci, for today. So I appreciate you allowing me the time.
Well, thank you, Todd, and I completely agree. Appreciate you mentioning that. We do want to be a resource for our clients and people who are needing it, that they're just not able to get the other answer. So thank you for being a part of today. Obviously, as you all have had the opportunity to hear from Todd these last several days, you know that he is an expert in the benefits arena. And we are very blessed at Summit to have his leadership and insights to help our clients. So thanks, Todd, for your time.
Thank you.
Before we jump in, just want to make sure with Angie as we start, just want to thank everyone for being on, but also we know these are unique times. And so we just want to know that our thoughts are with you, your employees, and your families as well during this time. So with that, I think we're going to get to our main attraction. Angie, thank you so much for being a part of today and for sharing with us your expertise and insights. We know at Summit that just like at BKD, we both have clients who are large corporations and then down to small businesses, small business owners, and even individuals who are needing that guidance from a tax perspective. And so we felt like this would be a very timely topic, as by the questions that came in pre and just the things that you have done to prepare. So as we started talking about this, we wanted to just make sure that we start by talking about what are the tax laws that affect all of the above mentioned attendees as we go through this. And we know that people are joining from across the country. But with that said, Angie, how has the COVID-19, how has it affected the due dates for returns and estimated tax payments?
Kaci, thank you for having me today. Yes, many tax returns and payment due dates have been affected by COVID-19. The IRS has actually issued at least 3 different notices regarding due date changes and payment due date changes. So I'm just going to talk at a high level on different returns the most common ones and the due date changes. The last notice the IRS gave was notice 2020-23, and it was published on April 6th. So most people know that the due dates changed from April 15th and any balance due to July 15th without any penalty and interest. If an individual gets to July 15th and they need additional time, they're going to need to file a form 4868, so that'll extend them to October 15th. Any amounts not paid by July 15th, there could be penalty and interest that starts accruing until they make that payment. The IRS is actually really urging taxpayers to file their return if they are due a refund. So they're trying to get the money out to taxpayers. The next is business return due dates. So for C corporations, which if you're a calendar year in, they're due April 15th. In the notices, they said if you have a return due from April 15th to July 15th, they're moving that due date back to July 15th. And the interesting thing is if you're a fiscal year-end corporation and you have your extended due date in that time period, it moves it back to July 15th. So if you had your extension and it went to May 15th, now it's due July 15th. So that is a little bit of an advantage there. And this also encompasses trust tax returns, which are the 1041, estate tax returns, which is the 706, gift tax returns, which are the 709, and tax exempt tax returns, which is the Form 990. And this is all relates to the income tax returns. The next question is, what happens to my estimated tax payments and when are they due? So for individuals, their estimated tax payments are due April 15th and June 15th. Those have both been moved to July 15th. In the notices, they said if you had a payment due from 4/1 through July 15th, they've all been moved to July 15th. And so this also encompasses your estate trust returns, estimated tax payments, and corporate tax repayments. In these notices from the IRS, that doesn't include your payroll tax returns or most excise tax returns. So those due dates have not changed. Once you've kind of figured out what returns need to be filed and when they need to be filed, then you move and look at your state returns. And for Oklahoma, Oklahoma usually follows the federal pretty closely, and they have extended the due dates for individuals, corporate, S corporations, partnerships, and the first quarter estimated tax payments to July 15th. And this also encompasses any pass-through election payments. So last year you were able to make an election due if you're a pass-through entity to have the tax at the entity level. And that's been moved to July 15th also. However, the OTC as of Monday has not moved the second quarter payment, which for individuals is due June 15th. That has not been moved to July 15th. So individuals need to be aware of that. And I assume probably over time that may get moved, but as of right now, it has not. So for any other states, I would recommend that you go and look at that respective state's Department of Revenue website. And most of them have a COVID-19 area that talks about due dates. So some due dates may be moved, maybe income tax, maybe estimated tax payments or not. So be sure to check on that for any of your returns.
Perfect. Well, thanks, Angie. And I do know, BKD, I've noticed you all have a COVID website as well that people can go to. So it sounds like that can be a great resource for anyone that's on the call today to be able to also, I know Summit, we have one from a benefits perspective, but some of these tax implications, they can get further guidance that way. So appreciate you giving insight onto that. Angie, let's shift just a little bit if we can, talking kind of more about businesses, business owners. One of the questions that we've been getting, and I know we've come to BKD to get some guidance and help from your team on this is, so what tax incentives are there right now for businesses with respect to CARES, payroll tax, families first, kind of all of that together? I know there's multiple pieces to that, but what are these tax incentives for businesses?
So actually there was two different legislations that came out. One was the CARES Act, and the one before that was Family First Coronavirus Relief Act, which put in a sick and extended FMLA. So in the CARES Act, they put in two payroll incentives. The first one is the deferral of employer portion of Social Security tax. So an employer can defer the employer portion of FICA starting with March 27th through December 20th. This is the 6.2% of the taxable FICA wages. So it's an employer portion. The employee has their share at 6.2 also. If the employer isn't participating in the PPP loan, then they can participate in the deferral of the employer portion of FICA taxes through the date of the loan forgiveness. So originally it was believed that if you were in the PPP loan, that you could not participate in the deferral. But it has come out, some clarification has come out late that says, yes, you can through the date of the loan forgiveness. So if you decide to participate and defer the employer portion of FICA, then 50% of that deferment is due on December 31st, 2021, and the second portion is due December 31st, 2022. So it's kind of a loan for 2.5 years at no interest at this time. And this, you would start reporting this on your second quarter Form 941. So there's no changes for the first quarter, so you would start reporting that on your second quarter. The second payroll incentive they put in place was the employee retention credit. This is a refundable credit equal to 50% of qualified wages, up to $10,000 of qualified wages, paid to retain employees after March 12th and through December 31st, 2020. So for an employer to be able to qualify for this, their gross receipts have to be below 50% of the comparable quarter in 2019. So once they hit that mark, they can start participating. And once an employer's gross receipts go above 80% of a comparable quarter, they can no longer participate in this program. So an employer with an average of 100 or less employees in 19, then the credit is based on wages paid to all employees regardless if they worked or not. If the employer had an average of 100 or more in 2019, then the credit is allowed only for wages paid to employees who did not work during the calendar quarter. If you are participating in the PPP loan program, then you are not eligible to participate in this program. So it's an either or on that. And I think most people have been more interested in the PPP loan program at this time, but this is an option if for some reason you didn't get funded or you're trying, you can participate and have an option there.
That's a great discussion, Angie. Thank you for that.
So under the Families First Corona Relief Act, it's basically two separate provisions. One relates to sick leave and one relates to extended FMLA benefits. So if you have less than 500 employees and you are not exempt from in other reasons, then you're required to provide sick leave to your employees. If you have less than 50 employees, you could be exempt from this program, but the IRS has put out more guidance on that. So this entitles workers to be paid leave for up to 80 hours at the greater of the employee's regular rate of pay or minimum wage. And the max is $511 a day or $5,111 for 80 hours. And that's if you are home because of COVID-related sickness for yourself. If the employee has to be home to care for an individual due to illness, daycare closing, school closure, they will be eligible up for 80 hours at 2/3 rate of the greater of the employee's regular rate of pay or minimum wage with a max of $200 a day or $2,000 for 80 hours. Let's see. Then the second part of that is the FMLA, the extended FMLA. And this entitles employees to certain paid family and medical leave. If the employee is unable to work, including working remotely because of the need to care for a child if school or daycare is closed due to COVID-19, the employee is entitled to 10 weeks at 2/3 rate of pay at the greater of the employee's regular rate or minimum wage, and the max is still at $200 a day and at $10,000. So this act went into effect on April 1st and it ends on December 31st. Eligible employers are entitled to a fully refundable tax credit equal to the required sick leave or FMLA wages, plus allocable health plan expenses and employer share of Medicare tax. And this will be filed on the quarterly form 941. And the employer can apply for advance payment of the credit using the form 7200. So you can either file for it on your 941 or the 7200. So those are the three payroll things that have been put in place by the CARES or the Family First Coronavirus Relief Act. And they're trying to help employers keep people employed. That's kind of the goal of all of these, plus the SBA PPP loan. It's a way to help supplement and keep these employers going for a short time. Now I'll kind of move into more the income tax based incentives that they put into place. One of them is the net operating loss carryback. So when the Tax Reform Act was put into play for 18, they took away the net operating losses that could be carried back. You couldn't carry them back, but you can carry them forward. So under the CARES Act, it says, they're saying now any net operating losses generated in tax years beginning after December 31st, 2017 and before January 1st, 2021. So basically 18, 19, and 2022, you can carry these back 5 years. So if you had a net operating loss in 18, it could be carried back to 2013. And the reason this is beneficial is because under the Tax Reform Act of 2020 or 2018, they changed the corporate rate to a flat 21%. So back in earlier years, the max marginal rate was 34%. So you can maybe carry this back and get a greater portion of taxes back than carrying it forward because you might have been in a higher tax bracket in those years before. The IRS is allowing these claims to be faxed to the IRS. Normally, they don't allow returns to be faxed, but they are because they want to get them in and get them processed. And you would file that on a form 1139. And right now, the IRS is not having many people come in to work, so people are working remotely. So this is a way they can get paperwork moved around probably a little faster using the fax of this form. The other change that they have put into place is the alternative minimum tax credits. So under the Tax Reform Act of 18, they repealed alternative minimum tax for corporations and allowed corporations to claim refunds of outstanding AMT credits over a period of time. Corporations are now able to have those AMT credit carry forwards refunded to them in either 18 or 19. And those can either be claimed on your 19 return or you can go and amend your 2018. So that is a corporate level AMT. AMT is still in play for individuals. Another big program they put into place, or a technical correction they did, is for qualified improvement property. So basically, this is generally your leasehold improvement. So if you went into a building, a retailer, you go into a retail space and you build it out to what you need for your retail space. Those improvements, starting in 18, because of the law change, you had to depreciate those over 39 years. And prior to 18, there was some provisions in place that said it's really 15-year property, and you would be, because it's 15-year property, you can use bonus depreciation on that. Well, with the law change, they took that away. They didn't write the law quite right. And so this CARES Act is correcting that. So those qualified improvement properties are now 15-year property and can be 100% bonus. So that's a great advantage to retailers and people who have leasehold improvements. And to claim those changes, so that went into play during, they changed it as of 12/31/17. So anything that was purchased and put into service in 2018 now can have that accelerated depreciation. So you can either go back and amend your 2018 return, or you can file a form 3115, which is a change in accounting method with your 19 return. And through the mechanics of that, you could get that depreciation. Moving on more to charitable contributions for corporations. A lot of these provisions relate some more to corporations, but do have some follow through to individuals, and I'll get to that in a little bit. So under the CARES Act, the charitable contributions, or I'll back up a little bit here, before the CARES Act, if you were going to take charitable contributions on a corporation, you couldn't deduct, couldn't deduct more than 10% of your income for charitable contributions. Under the CARES Act, they've removed it, so there's not that 10% limitation. Another one is business interest expense for certain taxpayers were limited to 30% of adjusted taxable income. So that was put into play in the Tax Reform Act of 18 that said if your gross receipts over $25 million, then you can only deduct your taxable income at 30%, you can only deduct your business interest expense. So now they've gone in and said under the CARES Act, we're moving that 30% to 50%. So that probably can help many people also, or corporations. Under the next one, under the education reimbursement plans that some employers may have and may not, they can now include payments made on student loans. Before, they could only deduct, tuition, or maybe books, maybe some supplies. They had qualifying expenses, and it was usually school related. Well, now they've gone back and said, now we can do student loans included in those qualified expenses. But this is only through the end of 2021. So 2020. When you move to 2021, that does not apply any further.
Okay. Well, Angie, I thank you for all of the information with respect to the businesses and how it's relating. Sounds like there are a lot of changes that are occurring. I know as we were preparing, we talked about with Todd just how often that you are getting new updates, and that that will continue to occur. So we want to encourage everyone to reach out, talk to your CPA, use the resources that you have to make sure that you're doing what's best for your company as a whole and your business. And so with kind of that to shift over, I know we had also said we want to make sure that we talk about the individual side of it. So now, Angie, what are those tax incentives that individuals need to be aware of, or that they could take advantage of?
So what most is being publicized right now, and what most people are really interested in, is that economic impact payment. And so that's the $1,200 per person payment that you possibly could receive, or $2,400 for married filing joint, plus $500 for any qualifying child under 17. There are some income phase outs that relate to that. So if you're single and your income's over $75,000, then you probably won't get that payment, or for married filing joint, it's $150,000. Those the IRS has a really good their website is really good, and they're trying to get direct deposits through their website. They're trying to let people log in and see if they're going to get the economic payment. I've had several clients call me and say, hey, I think I'm supposed to get it, but the IRS website says I'm not eligible. Well, under the rules, they say they're going to look at either the 2018 or 2019 return. The people that have called me, the 2019 return has not been filed. So I'm assuming they're looking for the 2019 return, and then they may process that payment. So even though there's going to be a full first round of these payments that come out, the IRS is going to process payments throughout the year. So it's not just one and done. They will continue to process payments. The other thing I think is interesting is, say in 19 you were eligible to get this payment, but in 20, based on your income or other factors, you weren't allowed to get it. They're not going to require you to do any repayment. So if you got the money, you got the money. And that's for the IRS website. So I think that's pretty interesting. The IRS, like I said, is having some issues processing these payments. They're having to get through a lot of people and process a lot of stuff. And I know they're trying to, their workforce and they're trying to move them home. So they're trying to do the best they can with the resources they have. So I would just recommend being patient with them and check their website on that. Also, if you didn't receive a payment in 2019 because they said you weren't eligible, you can still get a payment or credit on your 2020 return. So there are options. It's not a one-time thing. They're going to process through the year and look at your 2020 return. So I would say people be patient. I know a lot of people need the money right now. I think they're trying to do the best they can with what they've got right now also.
Absolutely.
So the next provision in the tax law change of 2018, they put in a business loss limitation on individuals. So several people, individuals could have Schedule C, self-employed income. They could have rental losses or real estate type losses. And in the 2018 law, they said we're going to limit business losses to either $250,000 per single person or $500,000 for joint filers. And under the CARES Act, they're removing that business loss for 2018 and 2019. So if you had a loss in 2018, you can go back and amend your individual return in 2018. And some of these losses may be coming through pass-throughs, through a partnership or through an S corporation. And if you're entitled to take it based on, you could have some other loss issues that are limiting that loss, like basis or at risk or something like that. But if you're entitled to that, you've made it through those hurdles and you're entitled to it and it was limited, you can go back and amend your 2018 return. Or if you filed 19, you can go back and amend 19. Also for individuals, like for corporations, the NOL carryback was put into play for corporations. It's also been put into play for individuals. So a lot of individuals have those pass-through losses that come from, partnerships, S corporations, trust, and those, any net operating losses generated after December 31st, 2017 or before January 1st, 2021. So it's basically 18, 19, or 20 can be carried back 5 years. And just like under the corporations, those earlier years had a higher tax bracket, so is in play for individuals. So you're definitely, if you have losses, you'll definitely want to look to see if you want to carry it back. So that's another thing that can be done. And the IRS is allowing those carryback claims to be faxed to the IRS. And for individuals, you use the Form 1045 to file that carryback claim. And I know that you guys have, Summit spent some time talking about the required minimum distribution requirements are waived for 18, and that there's no 10% penalty for COVID-related retirement plan distributions for distributions up to 100,000. So those are some retirement plans that are available. And I know that some plans can also, retirement plans can put some loans in place also. And you guys have spent some time talking about it, so I'm just mentioning it and moving on. The other thing that's available for individuals. So in 2000, the tax law of 2018, they moved the standard deduction for singles up to $12,000, and for married filing joint, $24,000. So a lot of people who itemized before are not itemizing. So they have said, if you make a charitable contribution, you can have it above the line, so it's not an itemized deduction of up to $300. And then that if you are itemizing, there was a provision in place that said you were limited, you had a 60% limitation. Well, they have removed that. So that is, they're wanting people to go out and contribute if they have money, and make that a little bit easier.
Okay. Well, I know that that was a lot of information from the individual side of it. And kind of to your point, Angie, we did cover the 10% penalty, the loans on a previous webinar. But I would say with respect, as you mentioned on the RMDs, that doesn't just apply, I know, doesn't just apply to IRAs, but also retirement plans. And that really came from the same thing that occurred in the 2009 when we had the global financial crisis, waiving that RMD requirement. So those of you that are over the age of 70 and a half, you know, that is a benefit for you. We actually had something else that happened with the Secure Act, but it's kind of been pushed under the rug just because the CARES Act had percolated so rapidly. And so I think that's something that I know advisors like ourselves and BKD and your consultant will talk to those of you about, with RMDs moving to the age of 72 instead of 70 and a half. That's another, just another one that I'm sure will get brought up more and more as time goes on and you're working with your individual CPAs and so on. Angie, we've got just a couple more minutes. And so I just wanted to just ask from your perspective, are there any other provisions that you would say, hey, make sure that you look out for this, or these are some things that have happened that you'd like our audience to be aware of?
Actually, there was a couple of things, or the extenders that were passed at the end of 2019, and people are quietly not paying as much attention now that we have the CARES and all the stuff that we're in now. So at the end of 2019, they extended, did some extensions of some provisions, and they have backdated several of these back to 2018. And the three things that I want to mention are stuff that are relevant for people here in Oklahoma, or that I see a lot in my practice. Is the first one is the Indian Employment Credit, and that is a 20% credit on $20,000 of wages and health insurance for a tribal member or a spouse of a tribal member. And if the employee's wages and health insurance are over about $45,000, that you're not eligible to take that credit. But, you know, we have here in Oklahoma, we have a lot of tribal members, and it could be significant. Plus, with corporations removing the AMT, the Indian Employment Credit is much more attractive because they were limited before because of AMT tax to take this Indian Employment Credit. Now it's a little bit more likely they'll take that. The other one is the Indian Reservation Depreciable Life was put back in play. So most of Oklahoma at some point in history was a reservation. A little bit of Oklahoma City is not, and some western part of Oklahoma is not. So starting after 12/31/17 through 2020, if you put in equipment or something like you get a shorter life. And that is something that we've used in the past. Right now, bonus is 100%, so most of the time you take bonus over the shorter life, but it gives you some planning opportunities. If say you don't want to take bonus, but here I can use this Indian life and get it, this asset over 3 years versus 5 years. So it's a planning opportunity. And the last one that I've seen is the empowerment zone tax incentives were reinstated back to 2007, the end of 2017 through 2020. So 18, 19, and 2020, they're put in place. So there's several things that are wrapped around this empowerment zone. And the one that I've seen most is the employee credit. So if you've got employees in there that meet certain qualifications, you could get a credit for, because you're an empowerment zone. So I think people, if you've got a third-party payroll provider, and I would say this on your payroll credits, I should have probably mentioned this earlier, is be sure you're talking to your third party and they are up to speed on all of these credits so that you're getting the best information, because they're going to be the one that administrates that if you're using the third party. So be sure you're in contact and you understand what they are doing and how they're collecting that information so that you can get the most that you're entitled to.
Oh, perfect. And I appreciate you mentioning that with coordinating with your payroll provider. And so thank you for that. Really, Angie, I appreciate, I think, so much just going into the details. I know appreciate so much your expertise and your consultative nature just to break these things down for people like me who want it as simple as possible, when it is really, for most people, it's a very complex topic. And so thank you for doing that. I know the resources at BKD and your team has been very beneficial. And so just want to say thank you to you for being on today, providing these insights. And our clients should know that if you have questions, please reach out to us after today. We've talked to Angie and her team, and I know that they will be happy to answer some of the details that may have come up or that have spurred further thoughts. I know I had a client reach out to me just the other day and say, hey, I was on the call last week and now I'm having these questions. So it is very fluid, and that's what you've said to us with every day. So Angie, thank you.
And then I'll add something else. The IRS is also putting out good information. So like for the Sick Leave Act, they have 67 FAQs out there right now to answer a lot of questions. I know some, you get in there and there's some nuances and you may need more information, but the IRS is really trying to keep up to speed and putting information out there. So be sure, look at the IRS website.
Excellent. Okay, thank you for that one too. So I think we're about at the close. I'm going to turn it back over to you, Megan, to close us out for today, and want to just say thank you once again to Angie and BKD for being our partners on this.
Absolutely. Thank you, Angie, Todd, and Kaci, for all your time and sharing this valuable information with us today. And we would like to thank all of you for joining today's session. Please be sure to join us or follow us on social media as we continue to plan more webinars related to COVID-19 and its impact. Part 5 of this webinar series is scheduled for next Thursday, April 30th at the same time. That session will be focused on return to work considerations and other human resource considerations as we return to a bit of normalcy. And our guest speaker for that day is Grayson Johnson, who is HR consultant from Summit. Also, we have COVID-19 resources available on our website, so please take a look at that for more information. But for now, thank you so much for joining us. Have a great rest of your day, and please stay safe.